Today, I'd like to talk a little bit about indicators versus price action. And probably you've heard that price action is the most important thing or important aspect about trading that you should pay attention to. And it's true, and I want to call your attention to several things that I use that might help you. Now, first of all, I use only two indicators, actually three on my chart. I use the previous day's close, which you see here. I always put a horizontal line on my chart to represent where prices closed the previous day. This is a 3-minute chart of the S&P E-mini on September 26th. So the first thing I do is I put a horizontal line to denote the previous day's close. The next thing I do is I put a rectangle to indicate the calculated trading zone using the Taylor trading technique. And I calculate this using a calculator that is George Taylor's formulas, and it boils down to a dozen calculations, and it comes down to two numbers, a support and resistance number and a range between the two of them. So I put the rectangle on my chart from 9:30 to 4 p.m. Eastern Time, of course, and I only use regular trading hours. Although I'm using the E-minis, which of course trade around the clock, I only use the regular trading hour numbers when I put the numbers in the open, high, low, close into the Taylor calculator, which calculates the following day's trading zone. The third thing that I use are stochastics, and I use a relatively fast stochastic 733. So those are the only three things that I put on my chart. And the rest is filled in by prices as the day moves on. Now, I want to point out something that I teach in my course. Of the 6 trade setups I teach in my course, gap, support and resistance, trend, time and price, momentum, and candlestick, one of the things that I tell students is watch for price movements where there's an immediate reversal. As you can see here in the first half hour of yesterday, today is the 27th, yesterday this chart is the 26th. As you can see, prices moved up, immediately was rejected. Prices moved up again, immediately rejected. That gives you a clue. The next thing that I do is I want to wait to see if I can determine the intraday high or low. Now, the intraday high or low is the highest or lowest price that the market is going to put in for the day. And that's usually put in within the first half hour to hour of the trading day. And it's very difficult, but it's critical. Now, yesterday, and I have my cursor right here at 9:45. At 9:45, the only thing that you could tell in terms of the intraday is that you couldn't tell anything about the intraday high or low because the intraday low could have been here at the open at 43.47, or the intraday high could have been here at 43.53. Isn't enough time. There's only 15 minutes that's gone by. But as the day goes by, and again, these are 3-minute candles, as the day goes by at 9:48, prices start to move down and then stabilize, and by 10 o'clock, prices move well below the high that was put in at 43.54. So by 10 o'clock, you could take a guess or an assumption that the intraday high was put in at 10 o'clock or at before 10 o'clock at 43.54. So how do you use that? Well, first of all, price action is more important than any of the indicators, or it is an indication of how to use the indicators. So first of all, in terms of the previous day's close, which the gap rather, that closes 75% of the time, it really looks like by 10 o'clock that this gap is not going to close. So that's one clue that's given by the intraday, by waiting for the intraday high or low, or assuming that you know the intraday high or low. The next thing, if the day in fact is going to be a down day, which the intraday high would indicate, if this is going to be the high of the day, and this is the low at 10 o'clock, you know that the prices are going to move more than this let's see, 54 to 44, 10 points. The market's going to move more than 10 points. So if this is the intraday high and the intraday low up until 10 o'clock was at 43.44, then it's likely that the prices are going to go lower. And the third thing, and I'm going to get back to this in a minute, the third thing is the stochastics. Now, stochastics go up and down within a range, okay? And stochastics are less important than the price action or finding the intraday high or low. Stochastics are good for measuring momentary swings between support and resistance. But of course, by 10 o'clock, we don't know where support and resistance is. All we know is the intraday high might be right over here at 43.54. It might have already been put in. So, having waited for that half hour to determine or make an assumption that the intraday high is here, we can take the Taylor trading zone, and I'm going to show you. How I use the trading zone. The Taylor trading zone, like every other indicator, has to be used with some judgment and experience. Now, usually the absolute support and resistance, that is the support down here at 43.25 and the resistance at 43.65. But this was a 40-point range yesterday. The absolute support and resistance is not that important because usually prices are going to be skewed because of market movement, because of rumors in the marketplace, because of announcements. So the absolute support and resistance of the trading zone is not always the most accurate. But what is fairly accurate is the range. Remember, I said there was a 40-point range yesterday. So using this indication, using the 10 o'clock assumption that the intraday high was up here at 43.54, I can take my trading zone and I clone it. I don't want to move it. I'm just going to clone it, make a copy. And I'm going to move the copy to wherever the intraday high or low is, where I assume it is, okay? And so I move my trading zone down where the resistance point meets the intraday high, which was 43.54 yesterday. To find out, now remember, this is 10 o'clock yesterday morning, to find out where the range of the day is likely to be. And as you can see, the range of the day, according to the transposed trading zone, was going to be down here. The market was going to move down to 43.14. Actually, it broke that low briefly, but then it closed right at 43.14. But be that as it may, there's something else that I want to call your attention to. So I know that at 10 o'clock, I figure that the low of the day is going to be, the market is likely, or is highly likely, to trade down 40 points and end up at 43.14 or hit that price. It could bounce off there, it could go below, but put in this range. So that's something that I can assume based at 10 o'clock. But also, I want to show you that in the initial movement, the Taylor trading support, you see where the price is open right over here. And when they drop, where do they drop to? The calculated support. So being knowledgeable about how to use a trading zone, we can look at this area here. And by the way, this is a time and price trade, my friends, right here. This is the first leg. This is the consolidation area. This is the second leg. So this was the trade and the time and price trade. But nevertheless, I wanted to illustrate how to utilize your indicators in conjunction with price action to make better assumptions and better trades. Thanks so much for watching. Trade safely. I'm Marv Eisen from Timeless Dollar Trading Academy, and I'll see you in my next video.